streaming.
I'll press OK.
Yes. We are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Les here with me in the Zoom room. We are ready to begin on time at 2:10 p.m. That is Eastern time, coming up again in just a few short minutes. Thank you all so much for your patience. I hope you are having a wonderful day and that you're enjoying the show so far. To those of you just joining us, welcome in. We will be getting started here on time in just a couple of minutes now at 2:10 p.m. Eastern Time. Hello, everyone, and welcome to the session. I'm pleased to introduce Les Masonson. I have him here with me. He's the author of the QQQ and TQQQ ETF Profit Machine. He also had worked on the Amazon best-selling All About Market Timing. That was one of his previous works. Now, Les is a highly accomplished stock market veteran with over 50 years of experience, and he has been trading the TQQ ETF and NASDAQ 100 E-mini futures for the past 15 years. And to our live audience, if you have questions throughout this session, feel free to share them in the live chat box that is located on the right side of your video player. And without further ado, Les, I will hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Thank you very much, Charlotte. It's a pleasure being here today, everyone. Thank you for spending your time this afternoon with me. I will make your time very worthwhile. ETFs are one of the most dynamic financial instruments developed in the past 33 years, and there are a lot of interesting strategies you can use with them. But I just want to mention one thing to begin with, and that is it's a celebratory day at Vanguard because their ETF with the ticker VOO has hit $1 trillion today. That's the only one that has done that, and it came out in 2010. And the other competing ETF that came out first among all ETFs was SPY, and they have about $800 billion in assets. So VOO has overtaken them, and now they get the crown for the top ETF. I have a lot of information and insights to cover today, but I only have 25 minutes, so I'll be moving at a rapid clip. What we have at the current time is an unbelievable bull market that has gone parabolic, and that this doesn't happen that often. The last time I saw it was in the 1999, when the NASDAQ Composite Index was up an unbelievable 86%. So we have a situation now where the SPY has gone up 9 days in a row. Today, it's a little bit shaky. The market's down a little bit. But what has led the rise in the market is the tech sector, Mag 7, and also the semiconductor indexes and all their component parts. So we all love to ride the bull market. It's very enjoyable. We all feel very smart, and we think it's going to last forever, or some of us do, or would like it to do, but it certainly doesn't. The problem is this. It does occur over time that we do have bear markets, and that happens like clockwork. The problem is no one knows when it's going to start, and no one knows how deep it is, and no one knows when it's going to end. So it's all a matter of timing, and therefore you need to use your indicators, as far as technical indicators, to help you determine that. If you just base it on your emotion or what forecasters say, you'll probably get it wrong. As far as my experience is concerned, I've written for this magazine for over 10 years. I write the ETF column. I also interview top traders, and I write software reviews. If you're interested in technical analysis, this is the best magazine out there. It's been around for 44 years. And if you subscribe to it, you get the entire archive to go into at your leisure. As far as my trading experience is concerned, I've been trading the TQQQ and the NASDAQ E-minis for 15 years. I was a financial advisor for about 6 years. I published 7 books. I have a master's degree, an MBA, and a bachelor's in finance, and I keep testing out a lot of trading strategies. I've been involved in the markets for over 50 years. I started very young, and I'm self-learned. My other 2 books that I wrote in the past were all about market timing and buy, don't hold. Don't let anyone tell you that timing is impossible or that time in the market is more important than market timing. It is not. Market timing can be done. I proved it with the information in my book. It came out in the 2nd edition. It's also printed in China. So market timing is a viable strategy. If you put the time in and the effort, you can make it work for you. So don't believe the hype on Wall Street that it doesn't work. It certainly does. One thing I want to mention before I get involved in the ETF discussion with you is a study done by Hendrik Bessembinder, and he did a study of stock prices of 26,000 stocks over a 100-year period. And he came out with the unbelievable conclusion that only 3.7% of stocks generated all the investor income and capital gains. And that totaled about 1,082 stocks created the total wealth out of the 26,000. And there were 46 powerful stocks that had a tremendous return that really concentrated most of the effort. And these are the top wealth builders. And among these, you'll notice all the Mag 7 are listed here. Even though the database he had started in 1926, those stocks didn't exist until in the last 20 years or so. So you can see the powerful nature of certain stocks. And you'll see other names there that you wouldn't believe would be on this list. For example, Coca-Cola and Chevron and DuPont, among others. But this is the problem. It's very hard to pick stocks that are being successful and don't go bankrupt or merge over the years. It's extremely difficult to pick a portfolio of stocks that will do well compared to, say, a SPY index. One book that I just came out with recently, if you wanted to trade indexes like the QQQ and TQQ, I've come up with many strategies and background information that's interesting if you're involved in those two ETFs or you want to get more data and understanding. I advise you to maybe check out the book if you're interested. Here's a quote from Barron's. It certainly pinpoints the situation. ETFs are a wonderful tool. So let's start with a definition. First of all, they are an open-ended vehicle and shares can be produced every day. New shares can be produced. It's a portfolio of stocks and they're traded on the exchange throughout the day. So you don't have to wait till the end of the day like in a mutual fund process. And the SPDR was the first ETF that came out, and then many others came out thereafter. Country ETFs, sector ETFs, and things of that nature. Why invest in ETFs? Here are 6 reasons. What characteristics do they have? They're basically, most of the index ETFs track a benchmark like the S&P or the Russell or the NASDAQ 100. And the key is there that the money is invested 95 to 100% of the time. They keep about 5% of the money in cash in case of redemptions. They don't really have too many portfolio changes. And the tax efficiency is very, very good. So you don't have capital gains declared, whereas they do that in mutual funds and you have to really pay the piper on that. Whereas in this case, they're very minimal. And the expense ratios are usually about a couple of basis points. So this is a very good, positive, low-cost vehicle. Of course, ETFs come with risks, and I put a few of them on the screen. I'm not going to have time to go into these, but like any investment, they have risks. Nothing is 100% guaranteed. Nothing necessarily will be rising to the moon, although many stocks will go bankrupt. But ETFs, since they have portfolios, they may go out of existence after a while if they don't have enough assets or the daily trading volume is low. About 250 ETFs go liquidate each year because of those 2 factors. A critical factor about ETFs is the annual expense ratio. This is the cost to run the fund, and it's typically pretty low, except in the case where you have specialty ETFs. They may run above 1%. Most of the time, they're about 0.03 to 0.25, etc. But it depends on how much expense they have in running the fund. As far as the expense ratios are concerned, you can see in this chart on the screen that they've come down since 2017. On the equity side, they're down to 0.44 in overall. Those are general equities. And on the right side of the index ETFs, they've come down to an average of 0.14. Of course, there are many that are much lower than that. There are other costs involved in working with ETFs. Of course, if they do any type of trading, there are trading costs, and they may lend the securities out, but there is tracking error too that gets involved in the process. One thing I want to mention that just came out recently, as of June 1st, Fidelity has instituted commissions on a number of ETFs because they feel that these small type of providers have not provided them enough payment for putting it on their platform. So what they do is they're going to charge up to $100 per trade now, or a maximum of 5%. And the ETFs I put down are the ones in the middle. The Round Hill has 51 ETFs, And the Ives ETF is the new ETF by Dan Ives. And then there's 28 other ETFs under the sponsorship of Curve, Inspire, and Webs, in which they have produced ETFs in which Fidelity will charge a fee. So if you're using Fidelity as a brokerage firm and you buy any of these ETFs, don't be shocked when you see a fee, because I'm giving you a clear warning now that will be the case. And they will probably tell you that when you get involved. If you want to do a trade, it'll probably pop up on the screen. This is an unusual situation and a first in the industry. As far as the capitalization of ETFs are concerned, they mirror what happens in the stock market. You have large cap and mid cap, small cap, and micro cap, all based on different amounts of money. And that's how a lot of ETFs are based when they on size. And then they have, they're set up in this way so you can select the ones that you prefer. They're equal weight as well as market cap weight. As far as the weighting now, it's a little more detail. The most common is market cap, which means the price of the share times the number of shares outstanding. And there are some examples in the bottom left corner. We all are well aware of those. Some ETFs are equal weight, which are each of the ETFs in there are approximately the same weight. And there are 156 of those. I've given you 5 examples at the bottom of the screen. And then there are a handful, probably about only 10 that I have listed at the bottom on the right side. And those are all price-weighted ETFs, which is an odd type of thing. So in the Dow Jones average, the the stock with the largest price has the most weight. So if a stock is $500 and one is $50, the one that's 500 is 10 times the weight in the portfolio. It's a strange way to do something, but that's how they've done it over the years. Just wanted to mention that to you. As far as some key points about ETFs, most ETFs are transparent, which means that at the end of each day, you can check on your screen and see what the portfolio is. And if you do that day to day, you can see any changes that occur. So you can see actually what the manager is doing. There are some, of course, that are semi-transparent. There are 80 of those, which means that they only show you their holdings on a quarterly or monthly basis because they don't want anyone tracking what they're doing and, riding the wave to try to take advantage of that. Most of the ETFs that are out there are passively managed, and 1,775 are actively managed. And that's how the situation is set up, although the actively managed ones are becoming much more popular. And so far this year, 80% of the ETFs are active. The new ones are coming out are active ETFs. And as far as the top 10 largest ETFs, they control 30% of the assets, which is an amazing situation. These are the largest sponsors of ETFs. As you can see, iShares, which is BlackRock, Vanguard, and Spider, SPDR, S&P, are the ones that have the most assets and dollars. And coming up, of course, in that big ranking is JP Morgan and Dimensional Fund Advisors, which are used by a lot of advisors. And Fidelity is number 9, even though they started very late in the ETF game. Vanguard was way ahead of them, even though Jack Bogle, the head of Vanguard, didn't really approve of getting into that market, but he was gone by the time that happened. As far as the growth of ETFs, it's been phenomenal. And it keeps going longer and longer, but actively managed keeps getting a bigger portion. As you can see, the flows are coming in heavily, more and more into active ETFs. It really started in 2023 in the fourth quarter. What's interesting about ETFs and mutual funds, this happens to be a slide of equity funds, mutual funds, and it shows that this is from Standard & Poor's. It's called the SPIVA report. It shows that the longer you go out in time, the fewer number of portfolio managers beat the benchmark. So for example, the S&P 500, all large cap funds, going out 20 years, 93% don't beat their benchmarks, the portfolio managers. And it's similar for all these different ETFs. The worst is large cap growth. Look at this. Almost 100% fail to beat their benchmark. Even in 1 year, 95% fail to beat the benchmark. So the problem is active ETFs, although they're coming out in droves, the question I have is why get involved when they can't even beat their own benchmarks? Just buy an index fund and don't worry about it, because all these active ETFs have higher expenses, which you pay for. What's happening now, too, is most ETFs are outpacing mutual funds as far as net flows. Certainly since 2020, the amount of money coming out of mutual funds is huge, especially look what happened in 2022, a monstrous decline in assets. There are factor ETFs. I put 8 of them on the screen as far as the different types. Based on academic research, momentum, quality, and size have had the most success in producing the best returns for investors. There are many categories of ETFs. Okay, I've listed a bunch of them on the screen. If you want any ETF in any category, it's available to you. The problem is there's a lot of ETFs that replicate each other. You don't need 10 ETFs to the large cap or mid cap, etc. So you have to do your homework and see which one offers the best value to you, which means going to the prospectus of the sponsor and looking at their performance, looking at their costs, and seeing what the situation is. And also don't be confused by the name. Just because an ETF has a certain name doesn't mean it's actually doing what it's saying it's doing. There are some newer categories of ETFs. As far as the actives are not that new as far as the name, but coming into the market, they've shown a tremendous performance. And in the last few years, I shouldn't say performance, they've shown a huge amount of inflow into those. The performance, I don't know how great it is. Crypto, of course, came out in January of 24. And you have your buffer and outcome and defined outcome ETFs. And now you have some private credit ETFs are coming out. Be careful of those because they're very illiquid. It may be hard to get out of those because of what they hold. There are a lot of popular passive ETFs. You're probably familiar with them. I put about 5 or actually 7 on the screen. These are the most common. You probably heard them over the years if you're involved in ETFs. Here are some active ETFs which are out there. Some of you may own some of these. Popular one is the JP Morgan Premium Income Fund, ticker JEPI. It's popular. It's doing very well. Now we have a category called buffer or defined outcome ETFs. And what they do, a buffer ETF is one that caps the upside and caps the downside to a certain extent. So you're really in between and you don't lose as much as you would in a bear market, nor gain as much in a bull market. So people like to be constrained so that they have a chance for a better outcome without getting destroyed in a bear market. Some of the primary issuers of these ETFs are in this right corner here. If you're interested in looking at these, just check out the sponsor websites and see what they offer. Defined outcome also is involved in using strategies that use options to generate income, and they use credit spreads and other techniques. Some of the defined outcome ETFs don't use buffers or caps, so you have to look at them carefully to see if they fit into your portfolio. As far as the top defined outcome ETFs, JP Morgan has a couple of big ones. They've come out. They've done very well over the years. And Goldman Sachs as well, and other firms. So just check it out when you have a chance. You can see here that JP Morgan is in the top 3. Huge amount of assets because they were out pretty early in the game. Another manager that does a lot of activity in this area is Dimensional. They have 1, 2, 3, 4, 5 of the top 10 are dimensional. Let's discuss the performance now of standard ETFs over the past 10 years as of last Friday. And look what's at the top. And this is 10 years, folks. This is not 1 year. These are the semis. Semiconductors have a long history of tremendous performance, but also during the bear markets, they get destroyed. You have a lot of tech here, mostly tech, and that's where the action is over the past 10 years. Leveraged ETFs are a little dangerous if you don't know what you're doing, or I should say a lot dangerous. You have to be very careful. They offer you leverage both up and down. So if in a bear market, you can use the inverse ETF, and hopefully it'll go in your direction. They're determined. The prices are checked each day by the fund, and they're set to a certain level so that they come out the next day at the right price. They're basically set to do a 1-day performance goal. So when an ETF says they're triple leveraged, so an example would be the TQQQ. If the QQQ goes up 1%, the TQQQ will go up 3%, but that's only guaranteed for 1 day. If you go out in longer periods of time, like a week or two or a month or two, and the market's flat or down, those ETFs will not, they'll certainly won't perform well, but in a rising market, they will even do better than the 3 times. So you have to be careful of these. Be very careful. There are 2 major sponsors of leveraged ETFs, ProShares and Direction. They both have a lot of ETFs to offer you. If you're interested in any of them, check them out. They have double as well as triple, and some of the doubles have done better than some of the triples due to the decay. They haven't decayed as much, so they come back quicker. So think about that as an option. You may not want to go 3x. And now I'll give you the best performance of the top ETFs that are leveraged. And guess what? Semis are on the top, and tech. And you also have here South Korea because of the chip situation. They probably own a lot of the chips. Taiwan Semiconductor, among others, maybe Samsung and some of those. Financials are up there, and the benchmark, the SPY, up 336% in 10 years versus near 16,000 for the direction. And TQQQ up 4,500%. That's where the action is. If you're on the right side of the market, the trend is your friend, you can do extremely well. Just want to put up for you some unique ETF tickers. I've put up a couple of them. There are probably another 20 or 30. They have unique and ticker symbols. You may want to check some of them out. They may do very well for you, but don't just buy a ETF based on its ticker symbol. As far as the launches are concerned, in April, we've had certain launches. Dan Ives came out with another ETF that he has. The other one he had was IVES. As far as the May launches, again, you can see there are all kinds of interesting names here. I'm not going to go into any of these. They're coming out very quickly. There's probably 1,000 launches so far in the past year. And there are 2,600, by the way, ETFs in registration. So we haven't seen anything yet. As far as investing in ETFs are concerned, you want to make sure that you know your risk tolerance level. You want to keep your retirement and non-retirement ETFs separately and handle them separately. You want to use technical indicators if you're interested in that, because as far as I'm concerned, it's critical. And use the weight of the evidence. Use about 3 to 5 indicators, and have a trading journal to make sure that you track what you're doing and keep learning every single day. As far as trading strategies that I would recommend, I've done a lot of work in the relative strength analysis field, where you compare ETFs to each other, like, for example, the sectors or among the countries, and use a 3 to 6 month look back period, you can try to see which ones are the strongest and stay with the strongest, looking back on a monthly basis. As far as the indicators I use the MACD and the RSI, etc. here. I use the standard indicators. I use a little quicker settings than the default, and I do very well pinpointing tops and bottoms within reason. And I also have done a lot of work on the ATI strategy backtesting. I suggest you can check out Gemini 3.5 and do some testing of backtesting some of your strategies. You'll see how tremendous that product is, and also yearly rebalancing. As far as what you should look for in 2026, I've listed a couple of the major categories as far as areas of interest that you may have, and they're all very hot areas. Bitcoin is not having a very good year. There are space ETFs, though. I'll give you a few of those. I just wrote an article for the Technical Analysis magazine. I'll give you 4 tickers: UFO, NASA, like NASA, NASA, the space agency, ROKT, Rocket, and ARKX from Kathy Wood. Also, I wrote an article a few months earlier on drones. There are a couple of drone ETFs out there, and I'll also look for rare earth metals and things of that nature. So there are a lot of hot categories. You may not want to put a large percentage of your money into them, but maybe as satellite positions, maybe 2 or 3% in each one, and you'll have a nice diversified portfolio as far as unusual and new ETFs. Also, there are a number of artificial intelligence ETFs. The price shown here is for 1 day. Don't get confused with that. So check these out if you're interested in artificial intelligence, see what components they own. As far as common investor mistakes, you're probably well aware of them. You probably made them, and I made them certainly, and I paid the price. You got to be very careful. You got to invest with persistence and logic. Follow rules, follow a trading plan, follow your exit plan, do your research. Don't listen to anybody. No one knows where the market's going. And don't listen to any forecasts, because forecasts are totally useless, as are the weather forecasts on many days. As far as more information on ETFs, here are 10 websites which you will find tremendous value. And I spend 2 hours a day looking at ETFs, reading about ETFs. Every day I learn something. Even though I've been investing since a teenager in 1957, I still learn something every day. I have 500 books in my library. I read books all the time just to refresh my memory. So talking about ETFs, here's what Jack Bogle said. I'll open it up to Q&A if we have the time, and I want to leave you, while I do that, with contact information. If you'd like a copy of this presentation when it comes out on YouTube next week, just send me an email and I'll ship it over to you. Also, I gave a presentation on triple leveraged ETFs at the Money Show a few weeks ago. So if you send me an email, I'll ship you the YouTube connection on that. Okay, that's it. Open for questions.
Thank you, Les. Thank you so much. And I'll see if we can squeeze in this quick question from Eddie in the chat. It's about the SOXL. He says, I've done that before. It is definitely extremely volatile, not for the faint-hearted. What would be your best case practices of like day trade for SOXL, swing trade maybe?
Yeah, you do what's comfortable for you. Everyone has their own thing. Day trading is the most difficult, because it's very hard to determine the trend as it changes by the minute. Most people would probably want to swing trade that, which means try to get into a trend that stays for at least a week or two. And just be careful, have good exit strategies, maybe use the 8 exponential moving average as a moving average. If it drops below that, you get out of it.
Thank you, Les. That's fantastic. This has been a great presentation. Such a pleasure to have you on the show.
My pleasure. Thank you, Charlotte. Thank you, everyone, for listening. Please contact me if you have any questions at all. I'm always available for you.
For
Have a
those of
good
you
day.
watching us live, be sure to stay tuned as we do have more in store for you in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.
Thank you.